After reviewing a lot of financial plans for incorporated professionals, one pattern keeps showing up. The question of how to pay yourself, salary or dividends, and it usually gets treated like it only has one correct answer. And that thought process is usually where the problem begins. The truth is, getting this wrong doesn't just cost you in the current year, it can have a real impact on your retirement savings, your CPP entitlement, and your overall tax efficiency over time. Hi, I'm Aidan McDermott, Associate Financial Advisor here at BLA Private Wealth of Raymond James. And if you're an incorporated professional, physician, dentist, lawyer, or consultant, how you pay yourself from your corporation is probably one of the most consequential decisions in your financial plan. And it's one that I find gets revisited far less often than it should. So if you're not having this discussion with your accountant every year, every 2 years, you probably should be. So today, I'm going to walk you through how salary and dividends each work and why neither option wins outright. Let's also talk about the key factors that actually drive the right decision for your situation. And if you find this helpful, you can feel free to like, subscribe, and if you want to walk through your own situation, you can always book a time with me using the link in the description down below. So let's start with the basics, because the mechanics actually matter. When you pay yourself a salary, right, your corporation deducts that amount as a business expense. So let's say your corporation earned $125,000 this year. And if you withdrew all of that as salary, the corporation has no taxable income left and no corporate tax to pay, right? This is a bit of a generalization, but you get the point. You then take that income and you're going to personally pay income tax on that salary income, right? You now have $125,000 of earned income. That generates RSP contribution room, but it also triggers CPP contributions, both the employee and employer portions, because you're effectively wearing both hats as employee and employer, right? Conversely, when you pay yourself a dividend, the corporation first has to pay corporate tax on its profits. It then distributes the remainder to you as a shareholder dividend. They're typically simpler to administer and carry a slightly different personal tax treatment, and it's designed to account for the corporate tax that you've already paid inside your corporation. This is what's known as the concept of integration, and it's central to understanding this whole conversation. Integration is kind of the Canadian tax system's attempt to ensure that income paid through a corporation is taxed at a similar overall rate as the income earned directly. This concept makes sense when you think about it, similar tax for the same income. But in practice, each province has its nuances, and those nuances are where the real planning happens. Let's take Ontario, for example, where dividends typically attract a slightly higher total tax than salary alone. But on the Northwest Territories, for example, it flips the other way and there's some tax savings. For most incorporated professionals, salary remains the default, and that's for a good reason. Salary generates RSP contribution room. And for professionals with years of accumulation ahead of them, the ability to defer income in their registered account, specifically the RSP, and let that compound tax deferred is really, really powerful. Dividends, on the other hand, they don't generate RSP contribution room. So if you're paying yourself a pure dividend strategy, over time that can force you to save in your non-registered corporate or personal accounts once you've maximized your TFSA and your RRSP and all those other accounts that aren't based on earned income. Salary also builds CPP entitlement. And paying into CPP today can feel like a cost, especially considering you're covering both portions. But for incorporated professionals, they don't have a defined benefit pension that most people are looking for, right? That golden retirement pension. So CPP can provide at least some level of pension income in retirement that's indexed and it's government backed, so it's relatively safe. And now with CPP2, the contributions are higher, but the eventual benefit is also higher, which leads to a more secure retirement income for most professionals. Salary can also help protect your small business deduction, that one thing that every small business owner wants to keep because it's the low tax rate. So if your corporation is earning even close to the $500,000 active income threshold, a pure dividend strategy means all of that income is taxable inside the corporation. And the moment that you go above $500,000, you lose that small business deduction, and every dollar above that is taxed way higher. So paying yourself a salary actually reduces the corporate taxable income and can keep you below that threshold. And that can potentially preserve access to the lower small business tax rate depending on your situation. Let's think about a person who just sold some capital property. We see this a lot with medical professionals who are thinking about retiring, right? They've sold their building where they ran their practice and now they're moving into retirement. That means there's going to be a huge capital gain inside that corporation in 1 year. And if they've also had some other income in that year, they can slowly eat up the small business deduction through the higher income and the passive income, which grinds it down. So paying more salary in that year might actually make more sense. There are specific situations where dividends are clearly the better choice, and missing those is usually leaving money on the table. The first is the refundable dividend taxes. This one's a little bit complicated, but if your corporation has a balance on its RDTOH, or the refundable dividend tax on hand account, paying a dividend triggers a tax refund back to the corporation. These typically arise from investment income inside your corporation. So if you have some common shares that are paying dividends, or you have some ETFs that are distributing and you've triggered a capital gain, that can build up the RDTOH balances, and you'll see that on your T2. So leaving that balance there means that you've already paid tax on some of that income, and it can be recovered just by paying a simple dividend payment. So paying a dividend is usually the most efficient way to recover some, if not all, of that refundable tax. The second is the capital dividend account. So if your corporation has recently realized a capital gain from the sale of, say, a property like our medical practice example, half of that gain is tax-free and flows into something called the capital dividend account. So if we say our medical professional, they had a building that they purchased for $500,000, and now at the time of retirement, it's worth $1 million, right? They sell that. The $500,000 difference on their capital gain, right? That's their total gain. $250,000 of that is included in their capital dividend account. That means they could pay out $250,000 to shareholders tax-free. Sometimes that means themselves, sometimes it's a spouse, it really depends, but that's generally how the process works. And what that means is that you've taken this money out of the corporation with no taxes. And it's one of the most underutilized planning opportunities we see. Sometimes we review clients' T2 returns for their corporation, and there's large capital dividend accounts that just haven't been paid out. And every year that sits there, it means that you're continuing to lose that value to inflation. The third opportunity is avoiding CPP in specific circumstances. So there are situations where an incorporated professional, they already have maximized their CPP contributions, or maybe they have other guaranteed income sources in retirement. They don't want to pay into CPP anymore. And it just means the additional contributions don't make sense anymore. So in those cases, maybe a dividend-weighted approach may be more appropriate. And one strategy that we used to see was paying dividends to a lower income spouse or adult family member to split income across tax brackets. That changed back in 2018 when the TOSI rules, or the tax on split income rules, came in, and that limited this strategy in most cases, right? We used to see incorporated professionals paying dividends to their children while they were going to university to split income and help that way. But that means it's no longer possible, right? So under TOSI, dividends paid to family members who aren't actively involved, which means I think 20 hours per week in the business, they're taxed at the top marginal rate. So that reduces the income splitting benefit pretty much to zero. There are some exceptions to TOSI, but they're pretty narrow and specific. So if you're currently paying dividends to a family member or have been considering it, this is an area where a mistake can be very, very, very costly and usually very challenging to unwind. So it's worth reviewing carefully. Please review this with your financial planner and accountant to make sure your strategy makes sense. Here's the thing about most conversations about salary versus dividends that is missed. The math alone generally doesn't drive the answer. It's a component for sure, but with the integration numbers being so close, in most scenarios, your decision comes down to your specific circumstances. How much RSP room do you have? And do you still need to fill that up? Does it make sense for your financial plan? Where is your corporate income relative to the $500,000 small business deduction limit? Does your corporation have an active RDTOH or capital dividend account balance that's sitting unused that could be exhausted? What does your income need to look like in retirement for your situation? Are you 5 years from winding down your practice or 30? A 35-year-old physician with decades of savings ahead has a very different priority than a 58-year-old dentist planning to transition out of their practice and they're looking to probably sell, right? The right compensation structure is the one that's built around those specifics, not a blanket rule applied without context. The salary versus dividend question doesn't have one universal answer. What it has is a set of factors. RSP room, your CPP strategy, your small business deduction, RDTOH, the capital dividend account, your stage in life, and that pulls the decision in each different direction. So getting those factors right, understanding your financial goals and what you're looking for from your scenario and weighing those correctly, that's where the real value of planning shows up. What I see most often isn't people making a clearly wrong choice, because generally there isn't one, but it's people making a reasonable choice by default and holding it far longer than it still makes sense. compensation strategy should be revisited regularly because your corporate income, your personal needs, and the tax rules themselves shift all over all the time. So if you're not talking about this at least annually, you should be. Having a structured plan can help bring more clarity and confidence to these decisions. So if you're looking for a second opinion on how you're currently paying yourself, book a time with me using the link in the description down below. Thanks for watching.